This is not the way you were ever meant to discover what I am about to share with you. Not through a government notice arriving in your mailbox, not through a visit to your nearest Social Security office, and certainly not from anything you would catch on the evening news. Because the people entrusted with overseeing your retirement money, the money you spent your entire working life contributing to, decided that burying this information inside dense regulatory language and federal fine print was sufficient. It is not sufficient. Not for you, not for the tens of millions of Americans who built this country through their labor, their years, and their personal sacrifice. And it is especially not sufficient at this particular moment, because what just changed inside the Social Security system beginning May 1st is something that every single retired American needs to fully grasp before their next payment is deposited.
Let me be direct with you. I am not here at Social Security Simplified to frighten you. I am not here to distort the facts or manufacture anxiety over something that carries no real weight. What I am here to do is lay out precisely what occurred, explain why it has a direct impact on your monthly income, and walk you through what you should be doing about it starting right now. Because the gap between the retirees who successfully protect their financial security and the ones who silently watch it erode almost always comes down to a single factor: information. Not fortune, not personal connections, not having a financial professional available at a moment's notice. Simply understanding what is genuinely happening and responding to it before the window closes. So here is what we are going to work through together. We are going to examine the cost of living adjustment that officially took effect in your May payment and unpack why the figure you were given may actually be working against your real financial situation once you account for everything surrounding it. We are going to address a historic revision to two provisions that have been quietly draining money from public sector retirees for decades, and explain why May is the month where that finally begins to turn around. We are going to examine Medicare premiums that are silently reducing your Social Security payment every single month and walk through a lesser-known appeals process that could recover hundreds of dollars monthly for you. A process the vast majority of people have never heard of. And we are going to cover the earnings limit, the tax situation you may be walking into unknowingly, and the precise steps you need to take this week to ensure the government is not holding on to money that is rightfully yours. But before anything else, let us examine what genuinely happened with the cost of living adjustment, because I believe there is a substantial disconnect between what people were officially told and what people are actually living through on a daily basis. The Social Security Administration announced a 2.5% cost of living adjustment for 2025. On paper, that reads like a pay increase, and in a technical sense, it is. For the average retiree, it translates to approximately $50 in additional monthly income. Across an entire year, that comes to $600. If both you and your spouse receive Social Security benefits, your household could be looking at waiting $200 or more in combined additional income. And yes, that adjustment is now officially reflected in your May payment. So if you have not taken a close look at your deposit amount lately, you need to do that today. Not at some point this week. Today. Because here is where the disconnect begins. That 2.5% figure was derived from something called the Consumer Price Index, which is the federal government's method of measuring how much everyday goods and services cost across the broader economy. In theory, the cost of living adjustment is designed to keep your Social Security benefit aligned with inflation, ensuring that as prices climb, your income climbs alongside them. But let me ask you something honest. Does your grocery bill feel like it only increased by 2.5%? Does your electric bill feel like it rose by only 2.5%? When you pull into a gas station, or pick up a prescription, or open your insurance renewal notice and compare it to what you paid last year, does any part of that experience suggest that 2.5% is covering the real difference? For the overwhelming majority of retirees, the answer is no. And that is not simply a perception issue. It is a mathematical reality. The Consumer Price Index tracks a wide basket of goods and services distributed across the full economy, but retirees do not allocate their spending the way someone in their mid-30s does. Retirees direct considerably more of their money toward healthcare. They spend more on housing. They spend more in the very categories that have experienced the steepest price increases over the past several years. So while 2.5% may reasonably represent the general economy, it does not represent your economy. It does not reflect what it actually costs to live on a fixed income in a country where essential expenses keep rising faster than the adjustment meant to address them. I want to be clear about something important. I am not raising this to leave you feeling defeated. I am raising it because understanding the difference between what the federal government characterizes as inflation and what you are genuinely experiencing is the foundational step toward making better decisions with the income you do have. That $50 per month matters. That $600 per year matters. But only if you are not quietly losing it somewhere else without ever realizing it. And that leads directly to the part of this story that most people have never been told. The part that could be the difference between barely managing and genuinely getting ahead. Because while public attention was fixed on the cost of living adjustment number, something considerably more significant was unfolding behind the scenes, something that affects a very specific population of Americans who have been shortchanged by the Social Security system for years. And if you spent any part of your career working in the public sector, or if your spouse did, what I am about to explain could represent thousands of dollars flowing back into your hands. Real money. Money you already worked for and earned. Money that was effectively withheld from you under rules that were never equitable in the first place. Stay with me, because we are only getting started. For decades, two provisions embedded inside the Social Security framework existed largely out of public view, quietly affecting millions of Americans who would not discover them until the damage was already done. The windfall elimination provision and the government pension offset. If those terms are unfamiliar to you, consider that a form of good fortune. Because for the people who were directly affected, these two rules were responsible for cutting hundreds of dollars from their monthly Social Security payments, and in many cases, far more than that, year after year, without end. Let me walk you through exactly how this functioned, because the depth of the unfairness is worth understanding fully. Consider someone who spent 25 years working as a teacher in a public school district. Throughout that career, their employer did not contribute to Social Security. Instead, they participated in a state-administered pension plan. But before entering the classroom, or perhaps during summers and weekends alongside their teaching career, they also held jobs that did pay into Social Security. They contributed their earnings, they paid their required taxes, they accumulated their qualifying credits. When they retired, they reasonably expected to collect both their pension and their Social Security benefit because they had earned each of them independently through separate employment. But the federal government did not view the situation that way. Under the windfall elimination provision, the Social Security Administration reduced that teacher's benefit on the basis that receiving both constituted a form of double dipping. A modified calculation formula was applied to their benefit that could cut it by hundreds of dollars every single month. Not because they had done anything improper. Not because they had exploited any system. Simply because they had worked in a public sector position that came with its own separate pension arrangement. Teachers were hit by this provision. Firefighters were hit by it. Police officers, postal employees, and state and municipal workers throughout the country. People who dedicated their careers to serving their communities were penalized for that service at the point of retirement. And then there was the government pension offset, which operated with even greater severity. If your spouse worked in the private sector, paid into Social Security throughout their career, and you were entitled to a spousal benefit based on their earnings record, the government pension offset could reduce or erase that spousal benefit entirely. This included surviving spouses, people who had lost their partners and were told they could not access the survivor benefit their late spouse had earned across an entire working life, all because they themselves held a government pension. Consider what that actually meant in human terms. A widow who spent 30 years educating children in public schools, whose husband spent his career in private industry paying into Social Security from every paycheck, could be told she was entitled to nothing from his record. Not a reduced amount. Nothing, because a federal rule treated her public service as a disqualifying condition. This was the lived reality for approximately 3.22 million Americans, and for the majority of them, there were no available remedies. They wrote letters to their representatives. They made phone calls that went unanswered. They organized. They advocated. They pushed for reform. And for years, nothing changed. Until now. The Social Security Fairness Act was signed into law. It eliminates both the windfall elimination provision and the government pension offset in their entirety. Not a reduction. Not a revision. An elimination. Both provisions are gone. And, in practical terms, that means millions of Americans who have been receiving artificially suppressed Social Security benefits are now entitled to their full benefit amount, the amount they should have been receiving from the beginning. But here is the piece that makes May especially significant. The Social Security Administration has been working through the process of recalculating affected benefits and distributing retroactive payments to all qualifying individuals. And May is the month when a substantial wave of those adjustments is expected to reach people. Some recipients are going to see their monthly payment increase by $200. Others will see increases of $400. Some will see even larger adjustments, depending on how severely their benefit was originally reduced and across how many years those provisions were applied. And then there are the retroactive payments. If you received less than you were owed for months or years because of the windfall elimination provision or the government pension offset, the Social Security Administration owes you that money back. Retroactive sums, lump sum payments, real dollars that were withheld from you under provisions that have now been erased. Some individuals are looking at retroactive amounts of $5,000. Others are looking at considerably more. The specific figure depends on your personal circumstances, your work history, how your benefit was originally calculated, and the duration over which these provisions were applied to your account. Here is what genuinely concerns me. I know there are people watching this right now who are directly affected by this change and have absolutely no idea. They never understood why their Social Security check landed lower than they anticipated. They assumed the calculation simply worked out that way. They accepted the number on their statement without question, because the system had conditioned them to feel that questioning it was not an available option. I need you to hear this clearly. Questioning it is absolutely an available option. It has always been. And right now, with both of these provisions eliminated, it is more urgent than ever that you look at your benefit with entirely new eyes and verify that you are receiving every dollar you have earned the right to receive. If you held any public sector position at any point in your career where your employer was not paying Social Security taxes on your behalf, you need to take action. If your spouse held such a position, you need to take action. If you are a surviving spouse whose benefit was reduced or eliminated because of the government pension offset, you need to take action. The Social Security Administration is actively working through these adjustments, but they are managing millions of individual cases simultaneously. The people who reach out directly, who call and confirm and follow up, are consistently the ones who receive their payments first. I am going to provide you with the exact steps to take later in this video, the phone numbers, the websites, the specific forms, everything required to move forward. But right now, I want to make sure the full significance of this moment has landed. Because for 3.2 million Americans, May 2025 is not simply another month on the calendar. It is the month the federal government begins returning what it should never have taken in the first place. And we are not finished yet. Because even if neither the windfall elimination provision nor the government pension offset applies to your situation, there is another change directly affecting your May payment that every Social Security recipient needs to understand. Let us talk about what is quietly reducing your Social Security check every single month and compounding the problem with each passing year. Medicare, specifically Medicare Part B. This is the area where I consistently see retirees losing money they are completely unaware they are losing. And it is a situation that frustrates me enormously because the majority of it is preventable with the right information in hand. Here is how it works. For most retirees, your Medicare Part B premium is deducted automatically from your Social Security payment before it ever reaches your bank account. You do not see it leave. It is gone before the deposit arrives. In 2025, the standard Medicare Part B premium increased to $185 per month, up from $174.70 in 2024. That difference alone represents an extra $10.30 extracted from your check every single month. Across a full year, that is an additional $123.60 being removed from your Social Security income. Now recall that 2.5% cost of living adjustment we discussed earlier, the one designed to help your benefit stay current with rising prices. For the average retiree, that adjustment added roughly $50 per month. But Medicare just reclaimed approximately $10 of those dollars before the deposit ever cleared. Your real net increase, the money that actually arrives in your account, is closer to $40. And that calculation only applies if you are paying the standard premium, because for a significant number of people, the situation is considerably worse. This is the dimension that catches most retirees completely unprepared until it has already been costing them serious money for months or years. There is a mechanism called IRMAA, which stands for Income-Related Monthly Adjustment Amount. It functions as a surcharge layered on top of your standard Medicare premium that activates once your income crosses specific thresholds. And the word income in this context is doing considerable work because the government does not evaluate what you are earning in the present moment. They look at your modified adjusted gross income from 2 years prior. For 2025 determinations, that means they are referencing your 2023 tax return. If your income in 2023 exceeded $106,000 as an individual filer or $212,000 as a married couple filing jointly, you are paying more than the standard premium, in some cases, substantially more. At the highest income brackets, your Medicare Part B premium can exceed $600 per month. That is more than $7,200 per year being deducted directly from your Social Security benefit for Medicare coverage alone. And a significant number of people find themselves in this position not because they are financially comfortable in any ongoing sense, but because they experienced a single elevated financial event in 2023. Perhaps they sold a piece of property. Perhaps they took a large distribution from a retirement account. Perhaps they realized capital gains from selling investments. One strong year on paper, and suddenly Medicare treats you as a high earner for the next 2 full years. But here is what almost no one ever tells you. You have the right to appeal your IRMAA determination. If your income has declined meaningfully since 2023, if you have retired since then, if you have reduced your working hours, if you have experienced a divorce, the loss of a spouse, or any other qualifying life-changing circumstance, you can submit what is formally called a life-changing event appeal and potentially have your premium reduced to the standard rate or brought substantially closer to it. The form you need is SSA 44. You can download it directly from ssa.gov or obtain a physical copy at your local Social Security office. You complete the form, attach documentation supporting the change in your income situation, and submit it for official review. I have spoken with people who were paying $400 per month for Medicare Part B, filed this appeal, and had it reduced back down to $185. That represents a savings of $250 every month. That is $3,000 per year returned to their own pocket. Real money. Life-altering money for someone managing on a fixed retirement income. And many of them came within a step of never filing because they assumed the amount listed on their statement was fixed and final. They believed that if the government had determined they owed that much, there was simply nothing to be done about it. That belief is incorrect. The government makes errors. The government works from outdated data, and you have every right to formally challenge a determination that fails to accurately reflect your current financial circumstances. So if you are currently paying more than $185 per month for Medicare Part B, I want you to pause right now and genuinely consider whether your income has changed since 2023. If it has, you may be overpaying every single month, and you are under no obligation to continue accepting that. Now let me move to something that affects an entirely different category of retirees, but carries equal importance. If you are currently collecting Social Security benefits while also working, whether part-time or full-time, there is an earnings limit you need to be aware of, and the applicable figures changed for 2025. If you will be below your full retirement age for the entire calendar year, you can earn up to $22,320 without any reduction applied to your Social Security benefits. Once your earnings surpass that threshold, Social Security withholds $1 for every $2 you earn above the limit. To put that in concrete terms, if your earnings come to $30,000, you are $7,680 over the limit, and Social Security would withhold $3,840 from your benefits distributed across the year. If you are reaching your full retirement age during 2025, the threshold is considerably more generous. You can earn up to $59,520 in the months leading up to your full retirement age, and the withholding formula is less aggressive, applying a reduction of $1 for every $3 earned over the limit, rather than $1 for every $2. And once you actually reach full retirement age, the earnings limit ceases to exist entirely. You can earn an unlimited amount with no reduction whatsoever applied to your benefit. But here is the element that consistently catches people off guard. When Social Security withholds a portion of your benefit due to the earnings limit, that money is not permanently lost. Once you reach full retirement age, the administration recalculates your benefit and provides you credit for those withheld months. Your monthly payment increases to reflect the amounts that were previously held back. But between now and that recalculation point, your available cash flow takes a real and tangible hit. And if you have not planned for that gap, it can feel as though you are being punished simply for continuing to work. And that brings me to one final element that catches people completely by surprise every single year. Your Social Security benefits are subject to federal income tax. I recognize the inherent frustration in that statement. You already paid taxes on that money when you originally earned it. You watched it withheld from every paycheck across 30 or 40 years of working life. And now the federal government intends to tax you again when you finally collect what you spent decades contributing toward. It feels unjust because in many respects, it is. But it is the current law, and planning around it is essential. Here is how the calculation works. The government evaluates what is called your combined income, which consists of your adjusted gross income, plus any tax-exempt interest, plus half of your total Social Security benefits received. If that combined figure exceeds $25,000 as an individual filer or $32,000 as a married couple filing jointly, up to 50% of your Social Security benefits become subject to federal income tax. And if your combined income exceeds $34,000 individually or $44,000 as a married couple, up to 85% of your benefits can be taxed. Those income thresholds have not been adjusted for inflation in decades. They were established in the 1980s and 1990s, and they have remained completely static since then. which means that with each passing year, as living costs rise and benefits adjust upward to keep pace, more and more retirees are quietly pulled into paying taxes on their Social Security income without any official tax rate increase ever being announced. The system is gradually taxing a larger share of retirement income through inertia, and most people do not become aware of it until they sit down to file their return and face a tax liability they were not anticipating. So here is what I want you to take action on this week. Not at some undefined point next month. Not eventually when you get around to it. This week. First, log into your My Social Security account at ssa.gov. If you do not yet have an account established, create one today. The process takes approximately 15 minutes. Once you are in, pull up your benefit statement and your complete earnings history. Review every year of your recorded work history and verify that it has been accurately captured. Your benefit is calculated using your highest 35 earning years. If any year is missing from the record, or if a figure appears lower than it should be, your benefit may be smaller than what you have actually earned. Report the discrepancy. Request a correction. Second, if your situation was impacted by the windfall elimination provision or the government pension offset, pick up your phone and call the Social Security Administration directly at 1-800-772-1213. The hold times can be lengthy and the process can feel slow. But you may be owed thousands of dollars in retroactive payments plus a permanently increased monthly benefit going forward. That single phone call may represent the most financially productive hour of your entire year. Third, if you are currently paying more than the standard Medicare Part B premium and your income has declined since 2023, download Form SSA 44 from ssa.gov and submit a life-changing event appeal. Do not forfeit money because you assume the government's determination was accurate. It is not always accurate. Fourth, if you are earning income while simultaneously collecting Social Security benefits, run the numbers carefully against the annual exempt amount for your situation. Know precisely where you stand so that an unexpected reduction in your payment does not catch you without a plan. You spent your entire working life earning this. Every early morning and every late night. Every paycheck that had Social Security taxes removed before you ever touched a single dollar of it. That was your money then, and it is your money now. The system is not going to advocate on your behalf. It never has. But you have every capability to advocate for yourself, and right now that starts with knowing exactly where you stand.